Hello everybody. In this moment we are talking about capital market. Capital markets are financial markets where people buy and sell various assets like stocks, bonds, and currencies. These markets include the stock market, where shares of companies are traded, and the bond market, where debt securities are exchanged. Capital markets provide a platform for businesses, governments, and individuals to raise capital, manage risk, and invest for the future. The dynamic nature of capital markets reflects the constantly evolving landscape of finance, shaped by economic trends, technological advancement, and regulatory changes. And how does a capital market work? In a capital market, the primary mechanism through which funds are raised is the issuance of financial instruments by the entities seeking capital. This issuance typically occurs in the primary market, where securities like stocks and bonds are introduced to the public for the first time. An initial public offering, or IPO, is a common method allowing companies to go public and raise capital by selling shares to investors. Alternatively, debt instruments like bonds represent a way for entities to borrow money from investors with the promise of periodic interest payments and the return of principal at maturity. Intermediaries such as brokers, investment banks, and other financial institutions facilitate the smooth functioning of capital markets. They connect buyers and sellers, provide research and analysis, and assist in the issuance and trading of securities. And then we move to types of capital markets. Let's explore the different types of capital markets. The first, primary market. IPOs, or initial public offering, and new issuances. In the primary market, companies make their debut or issue additional securities through IPO, or initial public offering. And the second, freedom to determine the price. Entities issuing securities in the primary market enjoy the freedom to set the issue price. This determination considers various factors, including the company's fundamentals anticipated growth, prevailing market conditions, investor sentiment, and the dynamics of supply and demand. And then the secondary market. About stock exchanges. Prominent stock exchanges in Indonesia facilitate the trading of existing securities. And then about equity trading, investors engage in the buying and selling of previously issued stocks, influencing stock prices based on market demand and supply. And then about debt market. The secondary market for debt instruments such as corporate bonds and government securities provides investors with opportunities for fixed income trading. And then derivatives market. We know Indonesia has a well-established derivatives market where financial instruments like futures and options are traded, allowing investors to hedge risk or speculate on price movement. And then we move to elements of a capital market. The first element is market sources of funds include individual investors, financial institutions, insurance companies, commercial banks, businesses, and retirement funds. The second, the regulatory bodies are responsible for monitoring and eliminating any illegal activities in the capital market. Securities and Exchange Commission, for example, oversees stock exchange operations. The third, investors invest money intending to make capital gains as their investments grow over time. They also receive dividends, interest, and ownership rights. The fourth, the market is primarily operated by stock exchanges, brokerage firms, investment banks, and venture capitalists or other intermediaries. The fifth, fund seekers include companies, entrepreneurs, governments, etc. For example, to fund the economy and development projects, the government issues bonds and deposits. And the sixth, these markets usually trade long-term investments such as stocks, bonds, and government securities. Moreover, hybrid securities like convertible debentures and preference shares are available. And then the functions of capital market. The first links borrowers and investors. Capital markets serve as an intermediary between people with excess funds and those in need of funds. Second, capital liquidity. The financial markets allow people to invest their money in exchange. They receive ownership of a stock or bond. Bond certificates cannot be used to purchase a car, food, or other assets, so they may need to be liquidated. Investors can sell their assets for liquid funds to a third party on the capital markets. The third, capital formation. The capital market plays an important role in capital formation. By timely providing sufficient funds, it meets the financial needs of different sectors of the economy. Fourth, minimizes transaction costs and time. Long-term securities are traded on the capital market. The whole trading process is simplified and reduced in cost and time. A system and program automate every aspect of the trading process, thus speeding up the entire process. And fifth, provides opportunities to investors. The capital markets have enough financial instruments to meet any investor's need, regardless of the risk level. Capital markets also provide investors with the opportunity to increase their capital yields. The interest rate on most savings accounts is extremely low compared to the rate on equities. Therefore, investors can earn a higher rate of return on the capital markets. I think it is enough for this session, and don't forget, give this channel your like, comment, subscribe, and share. Thanks for watching. Thank you.